Better start.
All right.
Okay, welcome to Billionaire Acquisition Mastermind, #1 M&A podcast in the world. If you're not subscribed, make sure you do. So today we're bringing on a special guest. His name is Mark DiSiena. Did I say it right?
It's DiSiena, but close
DiSiena.
enough.
Okay. He's an accomplished financial leader. His bio states Mark DiSiena is the CFO of Titanium Healthcare. He's an accomplished financial leader and business partner with 25 plus years of results-oriented leadership and broad-based experience in both public and privately held venture-backed businesses. He's highly experienced in building teams and scaling businesses, restructuring, and maximizing productivity. Mark's professional life has always been focused on increasing enterprise value and generating exceptional outcomes. So, Mark, thank you for being on today's episode. I appreciate your time.
Well, thank you for inviting me.
Absolutely. Now, I want to touch regarding, I was looking at your LinkedIn bio and the specialties you had listed, which are plenty. So I wanted to touch on a couple of those. First, debt covenants. Is this regarding the bank's debt covenants?
Yes, it is.
Okay, great. So when we look to acquire a business, Mark, we look to primarily use a cash flow based loan to fund that transaction. What we're looking at is bringing in a 2 times DSCR base, which we're able to service the debt twice. That's how we're able to give the bank, security. I'm understood that in regards to the equity gap, because banks look for either 5-10% equity infusion, that is dependent on the debt covenants, what is allowed or what isn't allowed. So essentially, we're looking to bring in an investor to close that equity gap. Is that allowed?
To close that gap, sure.
Yeah. It doesn't have to be our own money, right?
Correct.
Okay, great. Now, in regards to CFOs, because you're one yourself, what are the roles we want our CFOs to do regarding a company like us, being into investment banking and acquisition focus? What would the roles be for a CFO coming in?
I think, one of the things that the CFO has to look at is both the quantitative and the qualitative analysis. I think the quantitative is the easy stuff. You learn that, in school, and you can do NPV or any kind of analysis to get you to a quantitative. But to me, I tend to look at things more like on a qualitative level. And one of the things I'd like to look at is the management team. Are they senior? Do they have good education? Have they done stuff in the past that would show some sort of excellence and some perseverance, right? So it's a lot, a lot of people get kind of fickle, and they get in, and then they get, demoralized early, and then they tend to take off, when sometimes, you just have to wait it out and see how things pan out. So it's a waiting game. So, but it has no real conclusion to the book, right? It just keeps going, hopefully.
Right. And should we bring in a CFO from the jump, or a couple acquisitions down the line?
Oh God, I mean, that's such a great question. I've joined so many companies. I think part of the problem is, a lot of companies think they can't afford me. But early on, if a startup is good and the management team's good, I wouldn't mind joining in at very little salary and much more stock, right? So when I come in later, they're like, "Well, you're too expensive. We'll wait till we're bigger." And there's so many times where I'm just sitting there like, God, I just wish I was here on day one. I really could have got this thing in gear. One of the things we're doing at Titanium is we did a 51% joint venture investment into a telehealth business. I'm also the CFO there. This company is, no revenue. It just started out of, it just came out of, the trunk of Titanium, and it's starting to blossom. But you know what? The books are great now. And the company's only been around for like 6 months, but everything looks fantastic. Having, a CFO like myself doing that kind of work, because we're looking at doing things like Reg A Plus or SPAC. And these are things you really have to get in place early on because it takes years of financial data in order to move in that direction. You just can't wake up one day and say, okay, I'm doing a SPAC or I'm doing a Reg A plus. Titanium was more like that. But now we're getting on that road to get to that Reg A plus or SPAC or IPO. And Activa may actually, which is the telehealth business, may actually be more ahead in their financial disclosures than Titanium is today.
Right. So you're saying if we're looking to do something, do it right from the start and get the right players involved, so we could, avoid the vertible mistakes and get things done correctly.
Sure, absolutely. I can't tell you how many times I got to come in and clean up stuff. Right now we're doing a 2-year audit for 2019 and 2020. I wasn't at the company till like March or February of 2020. So I'm looking at 2 years worth of stuff with financial information I really didn't touch, but I have to go back and try to recreate what happened, why did it happen, is it accrued properly. A lot of companies start off in a cash business. I think a lot of companies really chase the cash first to try to grow the business and keep expenses down until something more spectacular happens. But it's always up to the leadership team to figure out if they want to bring in a heavier CFO or at least a pretty heavy controller.
Right. And for someone like yourself, what would you look for in a startup? What would you say, this is worth my time if I'm not getting the pay, I'm used to getting?
Part of it is just a gut feeling. I mean, what I go into some of these businesses and I think they're fantastic. I mean, Titanium, when I first heard about them, I was like, I don't know. I had worked in healthcare before. It doesn't really move the needle much. In the industry, it's full of like a lot of. It's very hierarchical in the healthcare space because the oldest physician is always like the top dog, and everybody just goes down. So technology in the healthcare space is always contingent on where that leader was in college. So if that leader in college was used to working on a PC, you using Lotus 1 2 3, by the time they're 80, they're still using that. Whereas the doctors today that are in med school are very much more used to that technology that we have today with SaaS and other things. But it's going to be a while before that individual gets to the top, right, and pushes that down. But by the time he or she gets there, their process is probably obsolete. So it's always so. But Titanium was different because we were looking at something that was completely different. We're trying to keep people outside of the hospital by doing our managed care services. Basically, we take high risk patients from hospitals and from insurance companies, and we manage them because lots of times people leave the hospital, and as you know, they wind up back in there like a month or two later because they were just let go. Like, hey, great, you're kind of okay. We'll leave our hospital. But I think with COVID, it was kind of a wake up call because and these beds became very valuable, right? We had people that who probably, if they were managed properly, would stay outside the hospital, whereas we can take in someone that probably needs a ventilator. So to answer your question, we're just looking for situations for me that really change the dynamic and really so it's more of a disruptive look at businesses. So when things are disruptive and I feel like, what, I can really be in this type of environment, I think it works out great. I remember when Warren Buffett spoke at our school back in back when I was at Stanford. He always says, invest in things that you know about. If you know about it, then I'm not an engineer, so for me, dealing with high level computer and back end stuff is probably not the place for me. But looking at stuff like healthcare and fashion and other things that are a little bit pulled away from that high end technology, but utilizing technology to make those companies work, is always a really good place for me.
Totally. Taking into consideration what you spoke about a bit ago, that a lot of the people or a lot of these healthcare companies are outdated in terms of their systems and procedures. Wouldn't that be a great selling point to get investors coming in and acquiring these businesses and basically bringing them up to date, up to standard in regards to that?
Oh my God, yeah. I mean, absolutely. I mean, when I came in, I mean, a lot of companies that I came in, I think every single company I've come into, when I've come in like a year or two later or 3 years later, when the company's starting to take off and they bring me in as a CFO, the first thing I do is I completely re-automate the entire company. Titanium, for example, was was on QuickBooks and everything checks were manual. I was just like, oh, I can't do this. I mean, I have to come in and put this. So I put NetSuite in, and I connected something like Mineral Tree to it, or it's similar to a Bill.com. So now the need for this low level work, I hate saying low level work, but more entry level work or data processing work goes away because Bill.com and MineralTree have an OCR, so they scan the invoices. The invoices come into my inbox. I forward it over to an address in MineralTree. They scan it. Saturday mornings, I kind of get up. I spend like an hour or so, and I can do like 35 or 40 invoices within an hour. And the system allows you to either put in ACH routing code so they get paid electronically, or the system will issue a free check and they'll get it, a couple of days down the road. I mean, that's one example. And I whatever I can do to automate and bring everything into our ERP system directly, and then output it into something like Adaptive Insights for budgeting and planning, or using something like Tableau for visual analysis. I tend to stay away from Excel. As soon as people start showing me Excel, I get really like queasy. I don't like Excel for running enterprise businesses. It just, it's not as stable as I like it. If someone leaves the company, that piece of document may vanish. So it could be a valuable piece. So I tend to like things that are more in the cloud and more in system based.
In sync. So, as for the CFO and private equity, what else can we look for the CFO to do other than basic CFO duties? Or is it just
Well, I mean, a lot of stuff we talked about what it was the accounting stuff and the enterprise stuff. There's a lot of times it's especially in startups or early stage companies, even like the one in Titanium. I run HR. I kind of run a little bit of the technology piece, the accounting and the finance. But there's also, I think, the real, I think, sweet spot that like CFOs like to do is be more like involved in investor relations, working with investors. How do you attract money, whether it's from debt financing or from equity financing? And how do you keep these investors happy? So, going back to the technology piece, I use Carta to manage all our investors, and I can send them emails directly through the Carta system. Activa is brand new and it's really small, and I was able to find a SaaS program called CapTable.io, and that actually does the same thing as Carta, except we don't get the valuation services, but it does create a good cap table, and it's free. So I'm always trying to find different ways to keep my team as lean as possible.
right? So you're saying the CFO can help with investors, bringing in investors and
Oh
debt
yeah.
funding?
Yeah, I think that's critical because a lot of times these investors are going to ask for specific information. What's your revenue? What's your net income look like? What's your EBITDA? And the only other person that probably is close to doing something like that, it would be the CEO. But sometimes they're more into the sales environment to try to grow the revenue as opposed to the little nuts and bolts that are going on throughout the company. And that's part of it. That's bringing in the cash flow to the company. The other part is the expenses. By using a tremendous amount of and technology, even though it may cost a bit, the amount of headcount you save is just tremendous. I mean, right now, Titanium, we're probably held, so I can't really talk too much about our numbers, but we will be somewhere between 25 to 50 million in revenue at the end of this year. Um, and I still don't have a controller, but I'm able to do a lot of the stuff that I do because it's all technology based.
As for CFO compensation, how can we go about that? So
Oh
essentially,
man.
we're starting out no cash flow until our first acquisition, right? Could we
Hmm.
offer a bonus after transaction once we start cash flowing? How do we go about the salary? How do we determine a good salary for the CFO?
It's I mean, well, there's a lot of stuff out there like salary.com. There's, um, Robert Half puts out a book every year talking about what the salary should be for, depending on the amount of experience, how big the company is, and what level that person is, and it kind of gives you an idea of what, and also based on the state that they're in. So you kind of get an idea. Typically, CFOs, I guess they're like, they like being at least at $250,000 a year. But then it comes a trade-off. Okay, hey, we can only afford you at 120, but we can give you, like 1 or 2% of stock. I mean, and so that's a good trade-off, right? So, and it just depends on the risk factor. Most CFOs that come up through the accounting side are not going to be as risk tolerant as a CFO that probably came from the investment banker side. So, so that's something you may want to consider depending on what you really need the CFO to do in your company. I mean, the titles sometimes could be a little bit misleading. Some people are called CFOs or VP of finance, but they're really controllers or accounting managers in companies. So their expertise dealing with the external part of the company is very difficult. So a good CFO would be able to really work outside the company with the CEO, doing presentations, answering questions, or double teaming at these analyst conventions, where someone that has more of an accounting or controller background that's less, that has a less appetite for risk is really going to stay more huddled inside the company with the employees.
Right, right. Uh, Check this. So I've heard about the CFO. The CFO, when we look to do a business acquisition, I've heard that the CFO has to sign on the transaction. Has that ever happened in the deals you've worked on, or?
Well, someone has to sign it. I mean, it could be the CFO. Sometimes, just by ego, the CEO likes to do it. It could, yeah. I mean, but they're legally, I'm also an attorney, right? So legally, any officer in a company can bind a company, right, on signing this sort of stuff. So, but when you're doing these acquisitions, typically it's already laid out by the board of directors, and they set some of the parameters in the acquisition, and they may, dictate that the CEO signs off, or the CFO signs off, or even a secretary of the board. So as long as a high level officer is signing off on it, it should be fine.
Great. Let's talk about investors now. I heard that investors are interested in the risk before the return. How can we do a risk assessment on a potential acquisition? You know, how can we go about
Um,
figuring out what are the if it's something that the investor's willing to put his money in, or if it's a deal we should just move on?
a lot of it, we're doing this now, right now. We're acquiring private practices, because we can take these private practice I'm sorry, patients, and move them onto our platform. So, and we can manage them, and then we get paid for that by either, some large insurance company like Anthem, or LA Care. Um, but it'll a lot of it depends on the history. So, I mean, one of the things we're looking at practices is like we have it's very strange. We have a phenomenal opportunity to look at practices because in 2019 they had a really good practice. 2020 COVID hit. So what happened? I mean, what is their, low watermark? I mean, we have some practices that just went off the cliff with COVID. We got one practice we're looking to acquire right now that they saw no drop in during the COVID time. So, so for us to acquire a company that kept its revenue from when pre-COVID into COVID, and now we're getting kind of a little bit out of, we're kind of getting out of COVID, and it's pretty flat. The risk becomes a lot less. So it's easy for us to acquire a business like that. But when companies have a really great year pre-COVID, and then they have a disastrous year during COVID, the risk becomes, well, is it worth investing in his business, hoping that we can turn it around somehow? And a lot of things we do is, we take our connections with our contracts, and we try to, bring that clinic onto that physician practice onto our program to also increase their flow of patients coming through. So it's all about synergy on a lot of level. If there's a lot of risk, and if you can understand that, where the bottom level is for some of these companies, then you kind of get an idea of what your risk tolerance can be. Right now is a great opportunity to buy stuff, because you can see a company, you know, doing great, and you can see a company when it's at its worst. And now, as we're starting to come out of it in 2021, you can start seeing how the company rebounds. So these 3 years that we're looking at is phenomenal opportunity to get a really good, assessment of what kind of assumptions that you want to put into your business model to see what the value of the company really is. In retrospect, that actually lowers your risk, because now you know what your bottom is.
Yeah, great point. Never thought about it like that. Another thing is, investor look for, they ask for, what's your 100-day plan? What is that comprised of?
100-day plan, meaning when a CFO first comes in.
No, no, no. In regards to us looking to acquire a business, when we look to present that potential acquisition to investor, they're interested on, what's your 100-day plan after a transaction? What
Oh
would that
yeah, yeah.
comprise of?
A lot of it is headcount, because headcount is the most expensive part of the company. When we acquire a business, um, if the company has a great technology platform like we do with NetSuite and some of the other SaaS programs we've connected on to NetSuite, like Salesforce and some of the other things, um, what people do we need to bring over from that last company into our business? So, and some companies have a big accounting staff. They're doing a lot of billing, or they're doing a lot of AR or AP. But if they're going to come into my company, that stuff is already automated. So those people, unfortunately, probably don't have much of a future with my business. But then we try to keep the people that are very, very talented and actually keep the company growing. People in sales, operations, and stuff like that. So in the first 100 days for me is really integrating the new people we have coming in to mesh with our culture, and at the same time trying to figure out who's not really going to add value and who will and would add value. I think that's the synergies you begin to see, because now the expenses begin to come down overall when you do a quality of earnings, but the revenue hopefully would stay flat or at least increase, because you're bringing something to the table to generate that. So that's pretty much what happens in the first 100 days. Culture is always important. Drucker always says culture will beat strategy anytime, right? So if these new people, I see it all the time. The new people coming in, we didn't interview them, right? We acquired them. So and getting them into our methodology and how we do business and any intensity of how we do business can be challenging for some people, especially if they're used to working for a company that maybe isn't tech savvy or maybe wasn't as robust as we do business.
Now, I received some information regarding investors. I want to run this through you. It says, finally, what's the game plan with the business? What are your intentions? What are you giving the investor concretely? For example, and there's a big issue. If you're looking for debt investment, does the business have assets that investors can file first position liens on? If not, then why would they put their money behind another lender if they aren't as secured? So the way we look to fund these transactions is basically majority position would be a bank or financial institution, with a minority position being an investor. Now I know banks look for first position liens on all assets. Let me give you an example of some numbers, right? Let's say I look to acquire this $1 million business. It's $1 million. We're gonna do let's say 600,000 with the bank, 60%. We're gonna do 30% seller funding, and then we're gonna do 100,000 investor. Now, for the 600,000 as a major portion, we're looking to use the cash flow of the business to service that debt. Let's say we have a 2 times DSCR. We're able to service it twice. So we want majority of the collateral to be on the cash flows, right? Having that in mind, the banks will want to see, what's the FF&E, especially equipment. They're not really interested in furniture, but the equipment, contracts, accounts receivable, so on. Having the bank taking all of that, what can we provide the investor as security other than just, hey, we have, the cash flow to support the investment and provide you the returns?
Yeah, I mean that's where a good CFO comes in, right? Who can articulate that story, and the CEO can corroborate that. Uh, Usually, banks that and they take that first level position, the interest rate is lower, so it's great. But people who come in secondary will charge a much higher interest rate. So it's all about growth. It's not about raising money, but it's really about taking money and utilizing it in order to grow the business. So I think if you have a really great plan and a great net present value of what needs to happen with the cash flow, I think that's a good story to tell the investor or potential investor that wants to come in. Again, it's all about what they feel comfortable in, what businesses they like, and do they like the management team? Can they trust that team? Right? Because these numbers, I mean, we're in a really crazy time, because I remember during the dot-com days, it was very similar to what it is today, is that we're moving really fast. Oh, sorry about that. So yeah, um, and taking that kind of perspective. So it's just very difficult to and to look at these things without really looking at the whole pie. It's not just a quantitative. That I think, again, it's so easy to do the quantitative stuff. It's the qualitative stuff. It's a touchy feely. What do you like? What you don't like? Did the CEO shake your hand? Did they look you in the eye? And we told it's the rapport in a relationship. I mean, I've met with many VCs, and some are just not interested, and some are really interested. We have a great management team at Titanium, for example. Not to poo-poo younger people, but all our team members are like, in their late 40s and 50s, like myself. So experience. We've done this so many times in all different ways and combinations, that's the stuff that the investors want to get on board on. I mean, when they see what we're doing and how we're growing, and the steps we're taking to automate everything, uh, we're getting people dying to invest in our company, and we don't want to sell our equity too early. But we're taking on more debt, because the equity is much more valuable to us right now. So it is that weighted average cost of capital. What's your equity worth versus what's the debt out there in the marketplace? Some people that come in later or secondary, they may want a convertible debt, and that could be kind of interesting for both the company and the investor as well.
What is that?
Convertible debt is when a company, a lender gives you money, and you have a certain period of time to pay it back, and then before the note comes due, or maybe a few months before, the debt holder has the option to exchange their debt for stock based on a specific price.
I
So
see.
so if you're a lender and you're getting back 8% or 5% or something, or 10%, or whatever it is, but the company's growing 300-400% a year, and you may want to ditch your debt and just change it to equity, and that's possible. But the debt instrument will dictate who has the obligation to allow the conversion. Is it the debt holder, or is it the company?
Right. You said, the thing with banks having first position lien is that due to a security, they're allowed to provide us lower interest rates, which is better, right? Could we offer
Hmm.
them a second lien position on higher interest rate? Would that be possible?
Banks are very conservative,
Mm.
and they're really controlled by the Fed. So the amount of information and the type of rigor that they go through is really intense. So they're never going to take a loan that's going to be higher risk. There is a secondary market out there, and there's sovereign funds and other stuff like that that you can go to that are willing to take these higher risks, but they want to charge a higher interest rate. Some are like 18%, some it could be like 12%. It runs a gamut. I mean, I've done convertible debt at the company before Titanium called Social Life Network, and we took on a lot of convertible debt, and we were growing, but then the cannabis space kind of fell under, and so our stocks started to go down, and a lot of these debt holders were started to convert, so at much very low prices. So for example, the CEO of that company, I had about 75% ownership by the company, and it's publicly traded today. You can look at it. I think he's down to about like 2% or something because we have billions and billions of shares out there. But it's kind of interesting because the stock did go down to like 0.0001, but now it's at 2 cents. So if you had bought in at 0.001, you could have made a tremendous return. Yeah, if
Yeah.
you put like 10 grand in, you could have made like a
Wow.
million bucks. Would have paid for my mortgage. It would have been great. But
Right.
but even I didn't have the risk tolerance to put 10,000 into my own company that I had worked before. So but it was a great management team because I know that because I know the people that I've worked with. So and I know the people that I'm working with today are a great management team as well. So a lot of people that have done this stuff before, and you get the warm and fuzzies, and then you kind of go down the aisle.
I feel like there's two types of investors. Correct me if I'm wrong. There's the guys who want more, more of an active involvement within their investments, the companies they invest on, and then there's the
Mhm.
guys that are just, looking to get their return on investment. Is that right?
Yes, yes. I run into very active investors, and sometimes they can be great. If they have a tremendous amount of expertise, like, if they're venture capitalists or private equity people. But sometimes you get investors that want to be active and they're like, doctors with a lot of money or something, or if they're looking to invest in something and feel like they need to constantly protect their investment all the time. I've had that as well. They're calling me up all the time. Active investors can be tough.
Okay, let me ask you this. So, what kind of legal entities do investors favor? You know, in regards to
Well,
mhm,
and definitely C corps
C
because
corps.
they're able to get, yeah, because they're able to get their stock, and I know like professional investors prefer to C corp, the private equities, the VCs, because they can quantify the share price, and then they know the number of shares. Working
Very
with.
quickly. Not looking to interrupt, but for a private company, right?
Mhm.
Would it be C
Yes.
corp still?
Yeah, I think in a private company, yeah, it's a C corp, and what's really great about that is you're able to offer shares to your management team. So that gives some skin in the game to the management team. I think that's why VCs and professional investors like that. I work with a lot of physicians, and they tend to like the LLC model. But you can't go public at some point with an LLC. Most company, I think every company, the Nasdaq and the New York Stock Exchange is a C corp. I don't, unless I'm wrong. I mean, I think they're all C corps. So that gives you already a vision that this is going to be something bigger down the road. Where an LLC is more like a membership, and you have a bunch of people together. Maybe they want to, change into a C corp. Maybe they just like the way they are, and it's just a cash driven business, and they just pay out these dividends that float through to the investors, and sometimes the investors like that. So it does run the gamut.
Right. So we, have in mind going public. So having it already as a C corp starting out like that gives that perception that we're looking to do something bigger with it, right?
Yes, exactly. It does give the percent because the thing is now the investors can sell their shares internally, or what you can do is you can just issue more shares and dilute the current management team and investors to bring in the new investors as well. Maybe depending on the size of the investment, they may want a board seat, or they may just want to be a little bit more involved in the business, or someone great. They'll just like, hey, you guys are smart, you run it. I always tell people, look, if it's not broken, don't try to fix it. And lots of times we get investors that come in and they're trying to fix stuff. And a lot of it is driven because they may be more on the banking side and they're looking at, financial statements as opposed to getting involved in who the people are and how, and really how people are treated. If you're a CEO of a company and you treat your underlings and horribly, you'll have a lot of turnover. So, but sometimes bankers don't see that. They figured you just have to push hard as much as possible to squeeze as much juice out of this fruit, and sometimes it can backfire.
Now, is there a major tax difference between LLCs and C corps?
There's a ton of difference between the two, and I wrote a memo on it. I guess I should have had it out. But the big difference is one is a group of members, and the profits of the company flow through to the investors. So that's how the C corp works. And so there's no double tax. Whereas in a C corp, the money doesn't automatically flow to the investors, and any money paid out to investors is considered a dividend, and that's doubly taxed. So it depends if the investor wants to pull cash out of the business all the time, whereas in a C corp, you're more prone to keep the cash in the company to grow the business. So I think that's why investors
Okay,
tend to like
I
a C
see.
corp more because the money is contained, dividends aren't paid out, and it's reinvested for growth. LLCs, it lends itself to paying out dividends because it's only taxed once. It's either on a corporate level
Right.
or on the shareholder level.
I've heard of LOCs treated as C corps. Is that a thing?
As an S corp,
No, LOCs treated as C corps.
LLCs treated as well, I mean, they're two different things, right? It's just like I said, one is doubly taxed if distributions are made, and the other one is not.
Right.
Plus, the thing is, every time you have a new member come in, or like you have to update your your membership agreement. Where in a C corp, it gives you a lot more flexibility to bring in members by either people offering their shares to get off the train or get off the bus. They've made enough and they want to go someplace else, or um, or they can just issue more shares. In an LLC, you kind of have to have like most people, if not all the people, agree that this new investor comes in. Whereas in a C corp, you just have your board of directors, and really, 51% is enough to get the new investor to come in.
Flows better, huh?
It flows better. It's much more flexible. It's designed that way to be in the public markets. LLCs are more designed to be more like partnerships and people that just really want to be together for a long period of time. The C corp allows people to come in and out of the company as you deem them, and as they want to get out, or they want to cash out or cash in, and it's more of a revolving door. In if you wanted that.
Now let me touch on this. Friends and family. Some people look to raise funds from them. What are the SEC's rules in regards to having friends and family coming in as investors? Due to them being passive investors, correct?
Yeah, there isn't any real SEC rule on that. I mean, there are rules about, they still have to be, all investors have to be a certain level of, wealth and a certain level of knowledge of the marketplace. And there's stuff you need to follow with the SEC, like 506C and stuff like that. So you don't get caught trying to sell shares, and without complying with the SEC and the local state rules in getting these investors in. A lot of people make the mistake of just, taking people's money that may not be sophisticated, and then when hell breaks loose and the company goes under, then they wind up getting sued. I wasn't told that this was going to happen. I never knew it can go under. You said it was going to be great. So people, I mean, I've sold stock to friends and family before in the past, and I tell you, it was the biggest mistake I ever made. I mean, I couldn't tell you because not all my startups are great. A lot fails, especially the ones in the beginning, because I just wanted to get into a startup and just do it and learn stuff and see it pop in the whole thing. So I get very like emotional about it. I'm like, oh, you guys should all be in this thing, friends and family. Well, you know what? The thing falls apart. The friends and family are not that sophisticated. They're going to come after me, and a few of them I actually had to dip into my own wallet and pay them back because I felt so bad.
Yeah, so you're putting relationships at risk, so to speak.
Yeah, everything in business is a relationship, whether it's an investor, whether it's your boss, whether you got friends and family. I mean, we're that kind of creature that we need to see people, see the white and the white of their eyes. We need to shake hands. We need to have dinner with them, see if we can laugh together. I mean, these are the things that really make investment important. Especially if you're a CFO, and like I said, if you're not outwardly facing, it's very difficult because a lot of these things that happen during the meetings is a lot of business talk, but it is a lot of fun talk because at some point things get really intense. Crises do hit companies like COVID and the real estate market crash in 2009 and and the dot-com bubble. I mean, if you can't get along during the honeymoon phase, you're not going to get along during the marriage.
Looking at it now. So would you say you want more of the accredited investors?
I do prefer accredited investors. Because a lot of it's because I'm also an attorney and a CPA, right? So working with accredited investors with me is really good. My tolerance isn't really for unaccredited investors because they need a lot of hand holding, and they're very afraid. And when there's a small dip, the phone is off the hook all the time. They got to get through. They got to talk to somebody. Especially to a publicly traded company, you can't really say that much either. And even a private company, you can't say, "Oh, everything's great. Just keep your money here." I mean, then also you start getting into like a bubble or some kind of a potential Ponzi scheme or something. So you just so it's very dangerous. Accredited investors have a large pool, and they're okay with losing some or most of their money, knowing that 1 or 10% of their investments are going to pop. So I mean, if you look at Benchmark Capital, they were never really that big of a firm, but they did invest in eBay. I think they lost money on most of their stuff, but eBay really took off. So they became a heavy hitting firm because they just had a ton of cash after that.
So I heard fundraising on a contingency basis is illegal. Can you provide more clarity on that?
Yes. It's just what it is. You can't guarantee how much funds that you are going to raise because it lends itself out to a lot of scrupulous activities, right? And the various characters like, hey, I'll take a percentage of this because it's hard to track, and it's probably just a rule that came around that was probably a lot of activities that occurred probably in the 1920s and 30s or whenever. I mean, there's always money always finds a way out. It's like water, right? It finds a way to a source. So if you don't put those type of restrictions down, then you could have people just going out and raising money for. I mean, I guess if I did that on a contingent basis, I could have multiple clients paying me, even though I only have one investor coming in. So maybe 100% of it, half can go to me and half go to somebody else. So there's ways of manipulating the system. So I think they just try to get away from that.
How much usually does it cost to fundraise, like the retainer?
Oh, I mean, it depends how sophisticated the CFO is, right? I mean, the fundraising could be really easy if the CFO has a great Rolodex of people. A lot of it is contingent on experience and maybe what school or fraternity people go to, or maybe they're ex-investment bankers. And again, if you're really friendly and outgoing, and you have a database of people, it's not that expensive. But if you're trying to raise money on your own for the first time and you never done it before, and you're kind of shy, it's a lot of work. I mean, it is a tremendous amount of work. I remember when I had my consulting practice, the money per hour was great, but I would have to spend 40 hours working to make the money, but I have to spend another 20 or 30 hours just chasing down a client to get a new client in case one fell off. So it's the same here. And that's where I think a lot of startup people get disillusioned because they're looking to raise money, and then it takes a long time. I actually like going into VCs. I say this to my CEOs all the time. When we're raising money, let's go visit a bunch of VCs that don't like us, right? And let's go in there. You know what they do is because when they don't like you, they really give you a laundry list of stuff that you did wrong. They love to just spat out and say, look, you didn't do this, you didn't provide that. You know what that does? It just gives me ammunition to bolster up my pitch deck. And then by the time I get to someone I really want to invest in me, it's already laid out. Someone's already told me, what I need to get there. No matter how great a CFO you are, how great a CEO, the deck is always going to have a lot of holes in it, and investors will always poke holes in that to try to, either one up you on intelligence, or they just want to make sure that their investment is safe if they come to you.
Absolutely. I want to touch on SEC Rule 332. You treat a stock purchase as an asset purchase for tax purposes. And why would we want to do that? Is it wiser to make a stock purchase or an asset purchase when making the acquisition?
Well, a stock purchase, in SPA, a stock purchase agreement puts you in a 20% tax bracket, right? Because it's a capital gain. In asset purchase, you're stuck at ordinary income. So a lot of investors that we buy want to do a stock purchase as opposed to an asset purchase.
Right, but you're also taking on the liabilities of that company, correct?
Absolutely true. Yeah, because when you're buying the assets, you're only picking up in the lease, some employees, like you said, the furniture. That's about it. But when you take on the company, you're taking on everything, right? Because that entity is now in your entity.
Now, in regards to bank funding, I was heard when you acquire the assets of a company and take it under a new entity, that entity is treated as a startup. Is that correct? Treated as brand new.
I don't know. I've never heard of that. It could be true. I'm trying to think. So you're saying
I saw this on two deals we're actually looking at. These are broker deals, but the owners of these businesses, they previously worked for a company which they acquired the assets, and they created their own entity, their own LLC, in which they took the assets under, and now it is treated as such. We can't fund these commercially because one is 1 year old, the other one's 2 years old. Even though they have the equipment and all of that, it is not that company per se, right?
Oh, I see. So basically, they did some sort of a merger and created a new entity from
Right.
that.
Yeah.
Right. So now your history is kind of like
zero.
new. It's
Right.
zero, right? It's no. Yeah, exactly.
And that's a problem, huh? So you'd say,
It can be.
I heard that there's, correct me if I'm wrong, shelf companies that have a track record of history already involved. Can you use that to take over the assets to say, hey, we've been in for 3, 4, 5 years?
I'm sorry. You said
Okay,
the
let me say it
shell
again.
company.
Yeah, I've heard that there's like shelf companies, the entities, basically the entities that already they've been filing taxes on, right? And they're empty, but they have all the other paperwork done. Could you use that to acquire the assets of a company and
Yeah.
already reflect, I've been in the market 3, 5, or X amount of years?
Yes, I mean, Social Life Network did that. We acquired a company that just was a shell, and we put our business into it, and that got us publicly traded. There is a lot of stuff going on today with SPACs and shells and all that sort of stuff, and I've gotten to be quite knowledgeable about that sort of stuff. One of the things you want is if you buy a shell, you want one that has 2 years of some sort of financial filings with the SEC, right? I mean,
Right.
there are a lot of companies creating shells, or a lot of companies have gone bankrupt and they didn't file for a while, and they're trying to sell these shells. I mean, they're kind of worthless because that now you need to wait 2 years in order to get financial audit statements of this new company in order to even get a listing. So it's a bit crazy. I mean, right now, one of the things that was interesting was when I joined Titanium, we were looking to buy or merge into a shell. And Social Life Network at the time, um, a few months ago or a couple of years ago, no, I'm sorry, it was a few months ago, with the market falling apart in cannabis, was considering maybe we can sell the shell. I mean, I would love to have bought the Social Life Network shell to bring into Titanium because I know I did those financial records for like 3 years and they're solid. And all I gotta do is swap out the business with our business and have 2 year. If we have 2 years of financial statements, then we're ready to go on the on the Nasdaq or something.
This may be the minor details, but when you merge with a shell, can you use your company name or do you have to take on the shell's name?
No, you can use any name. What you do is you do take on their ticker symbol though.
See.
So you'll have that ticker symbol, and if you want to swap it out,
Mm-hmm.
FINRA takes a long time to swap out or give you another ticker symbol. So the ticker symbol is really what stays. So you can keep the old name, the new name. It doesn't really matter.
Right. Now, let me share with you the deals we have that we're looking at. I want you to see your perspective on them. So these are broker deals. Myself, I don't like to do broker deals. One of the people I know, he reached out to me about them. He wanted some advice. So we took a look at financials. We were able to get the business at a pretty good price. One for 1.7 million, the other one for 2.5 million.
Mhm.
Cash flow for one is 550,000 net, the other one is 750. The one for 1.8, if I'm correct, we have a DSCR of 2.8 times, and the one for 2.5, we got a DSCR of 3.6 times, which is all great, right? All looks beautiful. The thing is, one, the owner's looking to retire, so he's just looking to sell. The other guy, is more of an expansion. He's selling for expansion, coming in with a team, help grow his business, without him, taking on liability, because we're taking it on.
Mhm.
Problem is, one is 1 year old, the other one's 2 years old, due to what happened. The shell, they acquired the assets and they incorporated with a new entity, so it has no history. We cannot fund this commercially. I see this more as a cash transaction, if I'm correct. But myself, I like to be a little more creative. So I thought about, what if we could 100% seller finance this transaction until maturity for one of them till it reaches 3 years, which is one more year to go, and the other one 2 more years to go, and then cash that out with the bank. But now that I'm learning about the shell companies, could we just buy a shell of a 3-year-old company, merge the assets with them, and go get it funded commercially?
Yeah, I mean, I think that would be a good thing to do. You just have to make sure the shell is a reporting entity, and that can work out.
And I could do all of that before the funding, the acquisition, or how do I go about it? I just
Uh,
present that plan to a bank. We're gonna.
yeah, well, the banks are never really going to look at it like, oh, that's a great idea, right? I mean, it is a great idea what you're suggesting. What banks will want to see really is committed cash flow, right? Like for
Okay.
example, if you had a contract, let's say that business you bought had a contract with General Motors that has a 2 year out clause or something. I mean, that's great because if if that contract ends, they still have 2 years of cash flow. So right, that's guaranteed. If there's a guaranteed amount. So it's that type of I guess story that needs to be explained to the bankers because that's what they really look at when you look at covenants like debt covenants at commercial banks. They really limit what you can do. I mean, I've had that when I worked at Cherokee. We had a lot of cash flow. We had a big contract with Target. which was guaranteed. So they would loan us money against that AR. The only thing is we paid dividends, and they wanted us to not pay the dividends. So these covenants are very restrictive on your cash and where it goes. They feel like, hey, you shouldn't be paying the dividend if you still own debt. So but sometimes you've got to pay the dividend to keep the stock up if the investors are already used to that. So it's these type of things that banks don't want to understand or can't understand. But a lot of it's because the federal government has so much regulation on banks.
So what's another alternative to a bank where there's more flexibility in regards to
Uh,
funding? Would you say I've heard about, the issue with, okay, let me tell you the thing about banks that why we look for them is because it does not dilute our holding equity, right? We're just paying
right,
them,
right, right. If
interest.
you believe in your stock, you should not be selling equity.
Right. Right. Especially when it's early stage and there's a lot to go, that equity is expensive. Taking
Yeah.
that into consideration, we don't want to do private equity for the same reason they're looking to take over majority. What's your experience with family offices? I've heard they're more flexible.
Yeah, they are more flexible. They're usually they have a lot of money. I mean, I met a guy once. It was kind of interesting. He really didn't tell me much about his background, but I think his family invented some sort of explosive stuff or a chemical that goes into explosives, which obviously, it's guaranteed money for for generations, right? I mean, we're nowhere near the end of conflicts. So. So yeah, so family businesses could do that, but again, they get because they're family, and sometimes the individual that's doing the investment may not be had experience in investment banking, or sometimes they just have money, they just want to put it to work and for the family and stuff. They may be very narrow in what they're looking to invest in.
Say what?
Again, they're trying to look for stuff that they like, that they know about, that they can, if they sort of financials or they sort of business model, they would get it right away.
Right.
Uh, like a thigh master business is an easy business to understand. You put something between your legs, you squeeze. Maybe one group of people may think it's dumb, and the other group of people think it's a great idea. Turned out to be a $500 million idea for Suzanne Summers. So,
Wow.
so you just don't know.
Right. Right. So reach out to them, speak with them. Don't make the assumptions. Just speak with them. Let me.
Right. Don't. Yeah. Try to
Mhm.
alleviate these assumptions, right?
Right.
Because people have a lot of assumptions. And communication is always for the listener. It's
Mm.
not for the speaker. So when you
Right.
communicate, you have to make sure you understand your audience, you understand the topic, and you understand what they really are afraid of, and try to calm that anxiety.
Right. No, and that's what we're doing. Bringing in experts like yourself really shines light. Really shines light. I want to talk
Hmm.
about just to finish with this because I appreciate your time and I don't want to take much more of it. Reg
Sure.
A plus. What is
Oh,
it?
love it.
And you told me you had a fundraise you wanted to touch on. Can you expand on that?
Oh man, I love Reggae Plus because it's the first time a small investor can get into something, without having to go through an investment bank, right? Because what happens in I mean, a Reggae is sort of like a mini IPO, so it allows privately held companies as well as I guess publicly held companies to go into the marketplace and raise money under SEC guidance, where they can raise funds as little as $10 or more, right? So and you can reach out to the small investors and discuss with them as long as you do the proper filings with the SEC. And when you get a Reg A plus done and it's filed with the SEC, it gives you 1 year to raise money. There's a tier one, and then there's a tier two. And a tier one allows you to raise, I think, up to like 20 million or something. And a tier two gives you like the ability to raise 50, or I forget the exact number today. But it gives you that opportunity. Social Life Network, for example, we did a Reg A for that company, and we went to the attorneys and we said, "Hey, how much is it going to cost to do a Reg A?" They're like, "Well, it'd be like 80 grand or something." And I looked in and I said, "You know what? I think I can do this by myself, right? I mean, I'll just take an old Reg A filing that was done. I'm also an attorney and a CPA. It's easy for me to write it and also populate the numbers in there. And we did. And we had our SEC attorney chime in on it. And he's actually really good. Fred Lair is our for Social Life Network is their corporate attorney, but he had also worked with the Securities and Exchange Commission. So when I had questions, he was able to get me into the examiner pretty quick. And since I'm both an attorney and a CPA, no matter who I was talking to, whether they came from the attorney side or from the accounting side, I was able to, get through all those questions really quick. So we got it filed. Great news is they raised enough money to break escrow, which is fantastic. They're on their way to into raising money. So it's good stuff. Uh, Full
Oh
year
no,
to
that's
do it.
amazing. And
Well,
so we could get our CFO to do it, raise money for our company.
yeah, absolutely. In a Reg A, I mean, it's difficult because if you don't have both the accounting and the legal background, it's hard to do these SEC filings. But if you get a CFO that's done a lot of these SEC filings with the right attorney, you can raise a substantial amount of money. I mean, for the last company that we did the Reg A for, I think the average investment was like $65 if you take the amount of money raised divided by the number of shareholders. And it's a great way to also increase your shareholder base because a lot of times you get these shell companies, they'll have like maybe 2,000 investors left because usually when people are selling shells, the company has gone down to like the pink sheets. The stock is worth very almost nothing, um, and then you're able to raise money on that. So it's good stuff.
Hey, Mark, I appreciate your time very much. I appreciate the insights you provided for, the listeners, and thanks again. This was
Well,
amazing.
I appreciate being on the call. It was really nice to chat about this sort of stuff,
No,
and hopefully
absolutely.
everyone got something out of it.
Yeah, last thing. Would you be open to another one later down the line as, people come up with more questions?
Yeah, I mean, yeah, absolutely. If you want to talk a lot, I mean, reggae is a really hot topic. I think the specs may come and go, that it could be more trendy, but I think the reggae will be something that's going to go on for a long period of time. I think it is a democratization for investors, the small investor. So I think that should be a really, I mean, I think I can spend an hour just talking about that.
Yeah, we could do one later down the line. Expand upon Reggae Plus. Because like I mentioned earlier, is not about doing things, but doing them right. Having the proper information and guidance can save you a lot of time and money and trouble. Right?
It is. I mean, you got to get smart people to do smart stuff. I mean, or else you'll be stuck with, an attorney charging you $100,000 to do a Reg A plus. And, but this stuff can be done on your own. I remember when I was a kid, I used to have to pay people to do my word processing. Now, when Word came out, I was able to do it myself. So it's these type of things. I like to do
Okay, I
things on
see.
my own.
Yeah, great
Yeah,
analogy. Great. Okay, thank you very much, Mark. I'll follow up with you on LinkedIn with the video, and hey, let's keep in touch. Thanks again.
absolutely. Absolutely. And stay safe.
Yeah, you as well. Have a great week. Good night.
You too. Take
Bye.
care. Bye bye.
Thank you, everybody. Billionaire Acquisition Mastermind, providing the value others aren't. And that's what we're all about, bringing in true insights from true experts